Welcome back to the deep dive. If you've been keeping an eye on, well, everything happening in decentralized tech.
Which is moving at light speed these days.
Exactly. You know the big unavoidable challenge, the one everyone's trying to crack, is speed. Scalability.
Always has been, hasn't it?
Pretty much. I mean, Ethereum is foundational. It's the bedrock for so much.
No question.
But its core design, it just wasn't really built for the kind of, high-speed, global applications we're starting to envision. Think retail payments or, intense online gaming.
Yeah, that instant settlement just isn't there. Ethereum prioritized decentralization, security, which was the right call then. But it left this vacuum.
A vacuum that's now filled with intense competition, right?
Oh, absolutely. It's basically a proving ground. We're watching this high-stakes Layer 1 war play out in real time. New chains are popping up, all vying to be the go-to high-speed infrastructure for Web3.
Okay, so let's dive into that. We've got a stack of source material here, really comprehensive stuff.
Let's go.
And today's deep dive, it's laser focused on two absolute heavyweights in the scalability race.
The main event, basically.
You've got the established player, Solana, battle-tested, been around the block.
Definitely seen some action.
And then the challenger, SUI. Newer, yes, but well-funded and crucially built on a very different architectural philosophy.
Fundamentally different, yeah.
So our mission today is a direct comparison. We're looking at their tech, their ecosystems, the risks involved, all to tackle that central question. Can SUI actually challenge Solana's dominance? Or is this a market big enough for both?
And that's the question, isn't it? For
Right.
anyone building, anyone investing in this space, the answer shapes where potentially billions in capital will flow.
It really does. We're talking about the future home for DeFi, for NFTs, for gaming.
For the whole architecture of decentralized applications, really.
Before we really get into the technical weeds, though, just
Yeah.
a quick point. If you find this kind of detailed comparison valuable, where we take all these sources and try to synthesize them into something clear and hopefully actionable,
Which takes a fair bit of work.
it does. Engaging with this really helps us out. Subscribing, maybe dropping a comment with your thoughts, hitting that like button.
It tells the algorithms that this is useful stuff.
Exactly. It boosts visibility, lets us keep doing these deep dives with this level of detail. So we genuinely appreciate every click.
It's like the community feedback loop, keeps the whole thing running. Okay, ready to jump into the tech.
Let's do it. All right, section 1, the technical core. Both Solana and SUI are basically shouting from the rooftops about being the fastest layer 1.
High throughput, low latency, tiny fees. That's the pitch.
But when you actually lift the hood and look at how they achieve that speed, their approaches are, well, worlds apart.
Completely different philosophies. It's not just tweaking parameters.
Yeah.
It's a fundamental split in how you design a blockchain for speed.
So Solana, it feels like they looked at the existing model, the sequential blockchain, and asked, how can we make this specific process incredibly fast?
Right. Optimize the ordering. Maximize efficiency within that known paradigm. Whereas SUI, they kind of threw that out.
They asked a different question.
Yeah, they basically asked, what if we don't need to order everything sequentially in the first place? Big difference.
Okay, let's start with Solana. Its core innovation, the thing everyone talks about, isn't just its proof-of-stake consensus. It's this unique hybrid approach featuring a proof of history, or POH.
And POH is really the key to understanding Solana's speed. You got to grasp the main bottleneck in almost every other blockchain first.
Which is?
Time synchronization. In a typical blockchain, validators spend a huge amount of time and bandwidth just talking to each other, agreeing on when a transaction happened and what order it belongs in relative to others.
That whole consensus process takes time. Latency.
Exactly. It's the network literally waiting to agree on the time. POH tries to short-circuit that whole conversation.
How does it do that? It's described as a cryptographic clock.
That's a good way to put it. Think of it as a super fast, constantly running function that takes an input, hashes it, then uses that output as the input for the next hash, over and over.
Creating a chain of hashes.
A verifiable, ordered sequence of hashes. Because each hash depends on the previous one, you get a built-in historical record, a proof that real time has passed between each hash.
Like timestamps baked directly into the data structure?
Precisely. So when a transaction comes into the Solana network, it gets tagged with one of these hash outputs. It's essentially time-stamped cryptographically before it even goes to consensus.
Ah, so validators don't need that pre-consensus chatter about when did this happen.
Not nearly as much.
Yeah.
They can look at the transaction, see the POH timestamp, verify its cryptographic proof is correct relative to the chain of hashes, and know its place in history. It drastically cuts down the communication overhead needed to agree on order.
Okay, that makes sense. Less waiting, faster processing. What's the implication?
Massive throughput potential compared to chains stuck in that traditional let's all agree on time first model. Solana can just fire hose transactions through much quicker.
But there's a trade-off, right? The sources mention hardware requirements.
Definitely. Running that POH function constantly and propagating that huge historical ledger across the network requires serious hardware. High-end CPUs, lots of RAM, high bandwidth connections for the validators. It's not something you can run on a Raspberry Pi.
So decentralization potentially takes a hit compared to chains with lower hardware needs.
That's the argument, yeah. Fewer potential participants who can afford the gear. But the performance payoff is undeniable.
And what are we seeing in terms of actual real-world performance?
The sources consistently point to Solana achieving, under real-world load, something around 65,000 transactions per second, TPS. Maybe a bit more, maybe a bit less, depending on conditions, but that's the ballpark.
And that 65K TPS isn't theoretical, it's what's actually powering its existing ecosystem.
Right. That's production-grade speed, supporting huge DeFi protocols, massive NFT mints, all happening right now. It's proven.
Okay, let's switch gears completely. SUI, this feels different from the ground up.
It is. The origin story itself is interesting. Developed by Mist and Lambs, which is staffed heavily by engineers who previously worked on Meta's, Facebook's Diem blockchain project.
Right, the project formerly known as Libra.
That's the one. So you can immediately see the mindset.
Yeah.
Building infrastructure designed for potentially billions of users, managing countless unique digital assets, maybe like in a global metaverse context. Scalability from day one was the focus.
And their approach isn't about speeding up sequential blocks.
Not at all. They fundamentally rethought the data model. Their big innovation is parallel transaction execution.
Processing things simultaneously? How?
It relies on two core pieces working together: the Move programming language and what they call an object-centric data model.
Let's unpack Move first. Why is the language itself so important here? It's not just another smart contract language like Solidity.
It's quite different. Move, also stemming from the Diem project, has this core concept of resources. Digital assets in Move aren't just data entries in a contract. They are treated as first-class resources.
What does resource mean in this context?
It means the language itself enforces certain rules. Resources cannot be accidentally duplicated or cloned. They can't be dropped or deleted implicitly. They must be explicitly stored or transferred. This prevents whole classes of bugs, especially things like double spending or issues with asset ownership that can plague other systems. It's built for safety around valuable digital items.
Okay, so enhanced security and asset integrity baked into the language itself. How does that connect to the object-centric model?
This is the really clever part for scaling. In SUI, everything on the chain, a token, an NFT, even a smart contract itself, is represented as an independent object. Each object has unique attributes, including its owner.
So not accounts holding balances, but discrete objects.
Exactly. Think of it less like bank accounts and more like a collection of individual items. Now, here's where parallelism comes in. SUI's network can look at incoming transactions and see which objects they intend to modify. If a transaction only involves objects owned by the sender, like you sending your own token to someone else or modifying an NFT you own, it's considered an owned object transaction.
Okay.
And if another transaction comes in at the same time, involving completely different owned objects, say someone else minting their own unique game item, these two transactions have no dependency on each other.
They don't touch the same data.
Precisely. So SUI doesn't need global consensus to determine their order. It can process them simultaneously, in parallel, on different validator cores or even different machines.
That sounds incredibly efficient. What about things that do involve multiple parties, like interacting with a DX pool?
Those are shared object transactions. If a transaction needs to interact with an object that doesn't have a single clear owner, like a central DeFi liquidity pool or a DAO contract, then it requires traditional consensus to order it relative to other interactions with that same shared object.
But the idea is that most transactions might just involve owned objects.
That's the bet, especially for things like gaming assets, personal tokens, or simple transfers. By parallelizing the vast majority of simple transactions, they aim to bypass the sequential bottleneck that limits other chains.
It's a radical departure. What kind of performance numbers are they claiming with this architecture?
Well, this is where it gets eye-popping. The theoretical claims, often cited from lab conditions or specific testnets, are up to 300,000 TPS.
300,000 compared to Solana's 65,000 proven.
Exactly. That's the tension. You have Solana's battle-hardened, real-world 65K TPS versus SUI's lab-tested, theoretically 5 times faster 300K TPS potential.
So it really boils down to this. Proven, optimized sequential speed versus revolutionary, potentially much faster, but less proven parallel processing.
That's the core technical debate. Which architecture will developers and ultimately users bet on for the future? It's a fascinating architectural showdown.
Okay, so we have these two different engines, but a fast engine is useless without a car built around it, right?
Absolutely. Moving into ecosystem health, raw TPS is just one piece of the puzzle. You can have the fastest chain in the world, but if nobody's building on it, if there's no liquidity, no users, it doesn't matter.
Dominance comes from the network effect. Developer buy-in, capital flowing in, actual people using the applications.
That's where the gravity comes from, as you said earlier. And this is where Solana clearly has a significant head start. We're talking years of development, community building, and real-world deployment.
But that momentum is pretty visible across the market. Hashtag tag 2.1 Solana's thriving market presence.
Yeah, Solana's ecosystem isn't just large, it's deep and diverse. It's arguably the biggest non-EVM ecosystem out there right now. You see major dApps that have become household names, at least in the crypto space, that rely completely on that high throughput POH provides.
Like Jupiter, for instance. It's huge on Solana, right? A big DEX aggregator.
Massive. And Jupiter is a perfect example of leveraging Solana's speed. In DeFi aggregation, you need to scan multiple liquidity pools, find the best price, and execute trades across them almost instantly.
Low latency is key.
Critical. It minimizes slippage for users, enables complex routing, and just provides a much smoother trading experience compared to slower chains where you might miss the price you wanted. 65K TPS makes that possible.
And beyond just DeFi trading, what about the user-facing side? Wallets, marketplaces?
Look at the Phantom Wallet. It's become incredibly popular, known for its slick UI and ease of use. It onboarded a lot of users to Solana.
It's often cited as one of the best wallet experiences, period.
Many think so. And then you have NFT marketplaces like Tensor, which really highlight Solana's strength in the NFT sector. For a long time, Solana was the place for high-volume, low-cost NFT trading after Ethereum fees became prohibitive.
The sources really emphasize this NFT dominance, things like the Mad Lads collection getting huge traction, but also real-world integrations. They mention Shopify.
Yeah, the Shopify integration via Solana Pay was a big deal. It allows merchants to accept USDC payments directly via Solana.
Which validates the speed and low cost for actual commerce, not just crypto speculation.
Exactly. It shows trust from a major mainstream e-commerce platform that Solana can handle real-world transaction volume reliably and cheaply. That's a significant validator.
And we should probably touch on the Ethereum gas wars context, too.
Definitely. When the Ethereum gas fees went parabolic during bull runs, it priced out a lot of activity. DeFi strategies became unprofitable, minting NFTs cost hundreds of dollars.
It was unusable for many.
Right, and Solana was there, offering a fast, cheap alternative. A lot of projects, users, and importantly, capital migrated over. It wasn't just retail. Protocols saw the opportunity too. This migration really cemented Solana's position as a serious Ethereum competitor, especially for high-frequency applications. Hashtag tag 2.2 strategic growing focus.
Okay, so Solana has this established broad ecosystem. SUI is obviously the newcomer. How are they approaching ecosystem growth? Are they trying to compete head-on everywhere?
It seems like a much more targeted approach. They know they're playing catch-up in terms of raw numbers, but they're focusing strategically on areas where their specific architecture, that object model and parallelism, offers a distinct advantage.
So less trying to be everything to everyone, more focused bets.
Exactly. The sources highlight 3 key areas: gaming, complex asset ownership, and user experience UX improvements.
Let's talk gaming. Why is SUI potentially better suited there?
Remember the object-centric design. Imagine a complex on-chain game. Every sword, shield, piece of land, character skill, potentially thousands or millions of unique items.
Each could be an object on SUI.
Right. And many interactions in a game involve players interacting with their own items or items they directly acquire. Modifying your character stats, equipping gear, crafting items.
These could be owned object transactions.
Potentially, yes, which means they could be processed in parallel. If you have thousands of players doing things simultaneously in a game world, SUI's architecture could handle that simultaneous state update much more gracefully than a purely sequential chain where everything gets queued up.
Lower latency, more interactive gameplay, potentially.
That's the promise.
Yeah.
Instantaneous asset updates, complex interactions without lag. This is why you see SUI making a big push with SUI gaming projects and actively partnering with studios, even those exploring AAA-style games with rich on-chain asset integration. They're betting that the next killer app isn't just faster to FSI, but truly interactive, large-scale on-chain gaming.
And this strategic focus is backed by serious money, right?
Oh, yeah. The sources consistently emphasize the huge venture capital VC investment behind SUI and Miston Labs. We're talking hundreds of millions of dollars from major players.
What does that signal?
High institutional confidence in the team, the technology, and the strategy. The VC money isn't just funding development, it's fuel for growth. It pays for aggressive ecosystem grants to attract developers, marketing to build awareness, partnerships.
It allows them to try and accelerate adoption in a way that Solana's more organic growth didn't necessarily have in the early days.
Exactly. SUI is attempting a more calculated, capital-fueled market entry, specifically targeting these verticals like gaming where they believe their tech has an edge. It's a different playbook. Hashtag 2.3 comparative metrics for the learner.
Okay, so Solana is broad and established, SUI is strategic and growing fast. If someone listening wants to track this race objectively beyond the narratives, what are the key numbers, the metrics they should be watching?
There are a few crucial ones that really tell the story of ecosystem health and momentum. You absolutely need to track these.
Lay them out for us.
First, total value locked, TVL. This is primarily a DeFi metric, measuring the total dollar value of assets users have deposited into a chain, smart contracts, lending protocols, DEXs, staking, etc.
How do they stack up currently?
Solana has a significantly larger TVL, orders of magnitude larger, reflecting its established DeFi ecosystem, deep liquidity, and user trust built over years. SUI's TVL is much smaller, naturally, given its age, but it is growing.
So a rapid, sustained increase in SUI's TVL would be a major signal.
A huge signal. It would mean serious DeFi capital is migrating or being deployed, showing confidence in SUI's stability and potential for yield generation. That's one to watch closely.
Okay, TVL is number one. What's next?
Second is developer activity. This is more of a leading indicator telling you where the builders are going.
How do you measure that?
You look at things like GitHub commits how much code is being written and updated for projects on the chain. You track ecosystem grants, how much money the foundation is deploying to fund new projects. And participation in hackathons are talented developers showing up. That signals the future pipeline of applications. Even if Solana has more current apps, if SUI's attracting the next wave of builders, that's a very bullish sign for its long-term ecosystem health.
Makes sense. TVL for current capital, developer activity for future potential. What's the third key metric?
Third is user growth. Are actual people using the chain. The key metrics here are daily active users, DAUs, unique wallets interacting with the chain each day, and the rate of new wallet creations.
This tells you about real adoption, not just speculation.
Exactly. Solana boasts high DAUs currently, driven by its DeFi and NFT activity. It has a large, established user base. SUI's challenge is to convert its focus, particularly on gaming and better UX, into a comparable number of sticky daily users.
So if those SUI gaming partnerships start translating into hundreds of thousands of DAUs from gamers,
that would be massive validation of their strategy. It would show they're tapping into a potentially huge new user base for crypto. That DAU number, especially relative to Solana's, is critical for gauging mainstream traction.
All right, we've covered speed and ecosystem growth, but there's another crucial factor, especially when big money or critical applications are involved. Stability. Reliability.
And negotiable. You can have the fastest chain with the most apps, but if it goes down frequently or unpredictably, trust evaporates very quickly. Institutions especially cannot tolerate unreliability.
So the focus shifts here from theoretical performance to practical, dependable operation.
And trust isn't just designed, it's earned, usually through surviving tough conditions.
Yeah.
You need to see how these chains perform under stress market crashes, attack attempts, unexpected surges in demand.
And when we talk about stress testing and reliability, we have to address the elephant in the room for Solana.
The outages, yeah.
Its history, particularly in 2022 and early 2023, was marked by several high-profile network outages, times when the chain just stopped.
Correct. These weren't just slowdowns. The network halted block production entirely for hours in some cases. It was a major black eye.
And it fueled that whole debate, didn't it? Did they push too hard for speed and sacrifice stability?
That was exactly the debate. The very architecture that enabled its high throughput also initially made it vulnerable to certain types of spam or denial of service attacks, particularly issues around transaction queuing, where a flood of transactions, sometimes malicious, could overwhelm validators and cause consensus to fail.
A tough period for them. But the sources emphasize that they didn't just ignore it. They've implemented significant upgrades since then.
Absolutely. This is crucial context. Solana has undergone major stability improvements. It wasn't just patching holes. They made fundamental changes. They implemented things like QUIC, which is a more modern and robust transport protocol developed by Google, replacing UDP for certain communications.
And something called stake-weighted QoS.
Yes, stake-weighted quality of service. This is really important. It basically prioritizes transactions based on the amount of SOL staked by the validator submitting them, meaning it becomes incredibly expensive for an attacker to spam the network effectively. Their low-stake junk transactions get deprioritized behind legitimate traffic from highly staked validators. It makes those kinds of resource exhaustion attacks much harder and costlier to pull off.
So Solana's story is one of hitting turbulence publicly, but then making core engineering changes to become more resilient.
Exactly. It was trial by fire. They were battle-tested, found wanting, and then arguably emerged stronger and more hardened. They've earned back a lot of trust through demonstrable improvements and sustained uptime since those fixes.
Okay, now contrast that with SUI. How does SUI pitch its reliability?
SUI's reliability pitch is inherent in its design, that parallel execution and object independence we talked about.
The theory being, if transactions are mostly independent,
Then a problem with one transaction or one specific overloaded shared object like a hyped NFT mint causing chaos shouldn't necessarily bring down the entire network. Independent transactions should, theoretically, keep processing. It aims for better fault isolation. Low latency is also part of the pitch, meaning less chance for certain queuing issues.
sounds good in theory. What's the caveat?
The big caveat, and the sources are clear on this critical perspective, is that SUI is still early. It simply hasn't faced the same level of sustained real-world stress that Solana has.
It hasn't had its trial by fire yet.
Not really. We haven't seen how its specific consensus mechanism for shared objects holds up during, say, a massive network-wide DeFi liquidation event triggered by a market crash, or how it handles unexpected emergent behaviors at huge scale.
So SUI promises reliability based on its architecture.
While Solana demonstrates reliability based on surviving past failures and implementing proven fixes, it's theoretical resilience versus battle-tested resilience, a very different risk profile. Hashtag 3.2 tokenomics and investment risk analysis. And these differing risk profiles, the maturity difference, the technical approaches, they map pretty directly onto the investment characteristics of their native tokens, SOL and SUI.
Let's break that down. Starting with the incumbent SOL, Solana. What's its investment profile look like now?
SOL is now widely considered a blue-chip crypto asset. That means a large market capitalization, putting it among the top cryptocurrencies. It also has strong liquidity, easy to buy and sell large amounts without significantly moving the price, available on basically every major exchange.
And crucially, that institutional adoption factor.
Yes, this is significant. SOL has achieved verifiable institutional adoption. You see it included in regulated financial products like crypto ETFs in some jurisdictions, or held in the treasuries of crypto companies, and even some traditional finance players exploring the space.
What does that signal to an investor?
It signals maturity, regulatory acceptance to some degree, and long-term conviction from large capital allocators. Buying SOL is often seen as a bet on a core piece of Web3 infrastructure that has proven its utility, survived challenges, and gained institutional traction. Lower perceived risk compared to newer chains.
Okay, now let's look at the challenger, the SUI token. How does its profile differ?
SUI has a smaller market cap, significantly smaller than Solana's, reflecting its newer status and less established ecosystem. Liquidity is generally lower too, though it's available on major exchanges.
So inherently riskier from a market perspective.
Generally, yes. But that smaller size also means it offers the potential for higher growth upside. This is the classic growth investment narrative.
Explain that trade-off.
If SUI's technology does prove revolutionary, if it captures that massive gaming market, if its parallel processing truly delivers on its 300K TPS promise under load and attracts significant adoption, then the SUI token's value could potentially multiply many times over from its current base.
It's the VC-style bet again. Higher risk, but potentially much higher reward if the thesis plays out.
Exactly. You're betting on the disruptive potential of a novel architecture and its ability to carve out a dominant niche or even overtake incumbents in specific areas.
So wrapping up this section, the core risk versus reward trade-off for someone considering investing is pretty clear.
I think so. With SOL, you're generally choosing stability, proven tech post-fixes, deep liquidity, institutional backing, and a mature ecosystem. The potential upside might be perceived as lower, more tied to the overall crypto market growth, but the risk is also generally seen as lower.
It's the established infrastructure play.
Right. With SUI, you're choosing technological novelty, a focused strategy on high-growth verticals like gaming, strong VC backing, but less proven real-world resilience, and a smaller current ecosystem. The risk is higher, the tech could fail to scale as hoped, adoption might lag, but the potential reward, if successful, is arguably much greater due to the lower starting market cap.
And if we just look at raw market cap and trading volume today,
Solana's market cap dominance is clear, reflecting its current lead in adoption and value locked. However, you often see quite high trading volume for SUI relative to its market cap.
what does that suggest?
It suggests significant speculative interest. The market recognizes the high growth narrative, even if the current fundamentals, like TVL, are smaller. There's a lot of trading activity betting on SUI's future potential. The market is clearly watching this race very, very closely.
Okay, we've dissected the tech, evaluated the ecosystems, analyzed the risks. Let's pull back now and look at the bigger picture. What does this specific fight, Solana versus SUI, tell us about the overall direction of Web3 and this whole Layer 1 battle?
I think it's more than just another pair of competitors. This specific comparison really encapsulates the central drama of the scalability wars in Web3 right now. It highlights the fundamental choices developers and investors are facing. Hashtag 4.1, defining the scalability narrative.
How so? What are the two sides of that narrative represented here?
Solana, with its POH optimization, represents the peak of the iterative approach. Taking the existing paradigm, sequential blocks, POS consensus, and pushing it to its absolute limit using clever engineering and powerful hardware.
Making the old model as fast as humanly possible.
Pretty much. Whereas SUI represents the revolutionary approach, tossing out the old model's constraints, redesigning the fundamental data structure around objects and parallelism, aiming for a step change in performance, particularly for certain types of applications.
Optimized for asset interaction, not just value transfer.
Right, and the outcome of this specific competition, who gains traction where, has really significant knock-on effects for several key market sectors.
Like DeFi liquidity.
Definitely. Where will the next wave of institutional DeFi capital feel most comfortable? Will it be Solana, with its proven track record, post-outages, and deep existing liquidity? Or will SUI's theoretical speed and low latency eventually attract high-frequency trading firms and liquidity providers willing to bet on the new tech? The winner influences where billions in TVL might flow.
And the NFT and digital asset space.
Huge implications there. Solana has the current lead in volume in established communities, but SUI's move language and object model are, arguably, technically superior for managing complex, dynamic NFTs. Think game items that level up, assets that can be combined or broken down.
Things that change state frequently.
Exactly. If the future of NFTs is more interactive and game-focused, SUI is architecturally well-positioned to potentially capture that market, even if it starts behind.
And ultimately, it comes back to institutional capital allocation. Where do the big conservative players place their long-term bets?
They demand speed, yes, but reliability and predictability are paramount. Will they favor Solana's hard-won stability, even with its historical baggage? Or will they eventually be swayed by SUI's potential for vastly higher throughput, assuming it proves itself reliable over time? Their choices will heavily validate one approach over the other. Hashtag 4.2 lessons for Layer 1 strategy. So watching Solana versus SUI isn't just about picking a winner. It provides really valuable lessons for anyone thinking about Layer 1 strategy in general.
What kind of lessons?
It forces you to weigh the power of technological innovation against the inertia of established network effects. Is a 5x theoretical speed advantage enough to overcome years of ecosystem building, developer familiarity, and user adoption?
That classic innovator's dilemma.
Exactly. And it brings us back to that core question for you, the listener. Based on everything we've discussed, is SUI a genuine Solana killer? Is it destined to supplant Solana eventually?
Or is the reality maybe more nuanced?
I think the sources and just logical analysis strongly suggest the possibility of market segmentation. It's not necessarily a zero-sum game.
Meaning they could both carve out their own space.
It seems quite plausible. Given there are very different strengths, you could see a future where Solana, leveraging its maturity, deep DeFi liquidity, and institutional inroads, remains the dominant chain for high-value financial transactions, large-scale DeFi, and maybe payments where proven reliability is key.
The financial layer, perhaps.
Potentially. While SUI, leaning into its object model and parallel processing, could become the dominant platform for on-chain gaming, complex digital identity systems, social media applications, and other high-interaction, high-object count use cases where its specific architecture gives it a real edge.
So DeFi lives on SOL, gaming lives on SUI. A simplification, but is that the potential outcome?
It's a very possible scenario. They could coexist and both be incredibly successful by focusing on different market segments where their respective technologies shine brightest.
Which ultimately means, for anyone listening and thinking about allocation,
You need to define your own thesis. What matters most to you? Is it the proven track record, the existing network effect, the institutional comfort level of Solana? If so, maybe SOL aligns better. Or are you betting on the disruptive power of a new architecture? Do you believe gaming and interactive assets are the next massive wave and that SUI's tech is best positioned to capture it? If so, then SUI, despite the higher risk, might align with that higher growth thesis. There's no single right answer. It depends on your conviction about where the market is heading. Hashtag tag outro.
wow, okay, we covered a ton of ground there. From Solana's proof of history trying to max out the sequential model,
To SUI's object-centric parallel processing trying to break that model entirely.
comparing that real-world 65,000 TPS for Solana against the, let's be honest, eye-watering 300,000 TPS theoretical claim from SUI.
Big difference on paper.
And then digging into the ecosystem, Solana's established depth, its TVL, its big names like Jupiter and Phantom.
Versus SUI's strategic focus, particularly on gaming, backed by that significant VC muscle, aiming for specific high-growth niches.
It really feels like the scalability war is heating up, and these two are right at the forefront, defining the terms of the debate.
Absolutely. The lines are drawn, the strategies are playing out. It's going to be fascinating to watch.
Which brings us to our final provocative thought for you to chew on. We spent a lot of time on resilience, Solana's past outages and subsequent fixes versus SUI's currently unblemished but also largely untested record.
That trade-off between battle-tested and theoretically sound.
Exactly. So thinking long-term, maybe 5-10 years out, when potentially trillions of dollars are flowing through these systems for DeFi, for gaming, for tokenized real-world assets, what attribute ultimately wins the confidence of that massive long-term institutional capital?
What's the deciding factor?
Is it the allure of unparalleled theoretical speed and architectural elegance like SUI promises? Or is it the hard-earned, proven, perhaps imperfect, but ultimately battle-tested reliability that Solana now represents after weathering its storms? Which narrative wins when the stakes are truly enormous?
Speed versus scars, almost. Something definitely worth thinking about as you watch these two giants evolve.
Food for thought. Thanks for diving deep with us today.
Always a pleasure.
We'll catch you on the next one.